We shift our focus now to explore how African economies can build more self-reliant financial systems amid a global rise in protectionism and reduced foreign capital flows. Our reporter Ntwaleng caught up with Cláudia Conceição, the International Finance Corporation's Regional Director for Southern Africa, to unpack how development finance institutions like the IFC can support this shift. Here's that conversation.
Foreign investment is necessary, no doubt about it. But local capital, it's also necessary. And looking at exactly at this more conservative environment where countries are looking inwards, it's the time for Africa also to look at itself. And as it was said in the panel this morning, it's time for Africa capital to start working for productive African investments. What is necessary to make it happen? Okay, one, because let's address first of all what is the biggest challenge for Africa capital to invest in Africa is on the perception of risk. There is a perception that African markets are not safe and reliable enough. So it's the role, what is required, and very much the role of governments with the help of multilateral agencies to support African markets to become investable. And how this is done? By creating investment environments that are transparent, that are reliable, that are safe. Because at the end of the day, the investor, being it foreigner or being it national, what does he want? He wants certainty. And this is what we need to make sure that it happens through proper regulatory frameworks, to proper enforceability structure where people actually can be certain that when they have a good project, they can invest on, and then they can have their money back.
You know, you talked about perception and risks around, or rather perceptions on risks around investing in Africa. Maybe then let's look at the role of DFIs in its form, right, in addressing some sort of these perception, and also, I guess, garnering all stakeholders to then work together.
Okay, what is the role of the fundamental role? And in various fronts. The first one is to help bankable projects to happen, right? You have all this big inflow of foreign investment. If you think about it, foreign investment mainly come to the most attractive investments that are the big infrastructure projects, right? But what about the smaller projects in the other sectors? What about the investment on SMEs? So it's the role of the DFIs to help those smaller projects to become bankable, not only through investment but also through advisory services to support these smaller entrepreneurs to put together what it takes for a project to be successful. That's one. The second one, as I mentioned before, is working with authorities, with regulators, with governments to make sure that the regulatory framework it's there to enable private capital. You need to have things like the payment systems need to be in place. Things like the FX regulations need to be enabling for foreign investments. Things like enforceability also, and things like the regulations regarding recover of investments for financial system needs to be in place, and that's the role of the DFIs. Another aspect is for the DFIs also to put the money where they talk, right? By investing. And investing not only with lending instruments, but also with equity to help putting businesses together, with the risking instruments to help with the patient capital and all that it takes to lower the risk of the various projects. So it's very much a multidisciplinary, multi-pillar approach that DFIs have the privilege to touch in all of it through talking directly with the investors, to talking with regulators, to talking with governments, and by the way, by borrowing also its expertise, local and global, to support those investors.
And just shifting focus now, you're going to be on a panel on non-performing loans, right, in African markets that have continued to be a strain on banks' balance sheets. And you'll be speaking on how secondary markets can assist with that. There's been an example being used of European banking markets and how they recovered post the financial crisis in 2008. Perhaps you can just take us through the kind of lessons African banks can learn from what took place in Europe post 2008.
That market of secondary markets actually acquiring NPLs from banks, so the NPL books from banks are very, very limited in Africa. There are very few markets where that is done successfully. But the reason, back to the first point, why? It has very much to do with the regulatory framework. We need the regulators to come in, right? Because you need regulations from the banking supervision side that really enable those secondary markets to happen, to work effectively, so that banks can sell to the secondary market. That's one. Second one, you need to make sure that also from a legal framework, like courts have work, right? There are some markets that once it goes to litigation, it's money lost. You just have to write it off because there is absolutely no follow-up. So the enforceability regulations need to be there and really needs to work, right? So what we'll be discussing this afternoon is exactly what it needs. Another thing that is important is data. We need data. We need credit bureaus. We need to understand who's whom. When a secondary market is buying an NPL, they need to get data to understand which asset are they really buying, right? At this moment, we have very few. You heard this morning that there are only around 10 markets in Africa with reliable credit bureaus. So this is something that also needs to be invested on, because it's very important for the secondary market player to know which assets is buying and from whom.
And I can imagine that that also just weighs on investor appetite, right? We speak about fragmented regulatory frameworks and also trying to fit in frameworks from Europe, from America to Africa, where we have totally different environments.
Yes, and that's one of the biggest mistakes, right? We need to localize and look at specific considerations in the continent, right? And yes, it talks, as you say, to investor appetite. Why? Because the investors don't understand the market. And you see now practically a shift where you see international markets actually demobilizing from the continent, and you see more African financial institutions engaged and operating in African markets, especially in the space of SMEs and personal banking, right? And this is exactly a reflection of Africans understanding the African environment much better. But still, those same African banks require support, because commercial banks exist to make a profit, right? But the risk remains high. Right? Now they need also support in terms of sharing that risk with somebody, and that's where the governments come in, because they also they have a role to play, and the DFIs also can play a fundamental role.
You mentioned something important there around commercial banks and funding SMEs, funding micro businesses. And this has been touted for quite some time now. I know in South Africa there's been major focus on the township economy and trying to grow these businesses. But there's always been an issue around access to capital. And what I'm hearing you say is that the capital is there. So is there a mismatch in a sense of perhaps the businesses, the small businesses, aren't finding these funders? What's the disconnect about?
The disconnect is, again, risk and risk sharing. If you look at the context of South Africa, it's very much an asset-based lending market, right? Where one of the main assets to give access to credit is what? Land, right? And you look at the majority of the population and you look at the land distribution, who have access to land. So most of these SME owners, most of these startups, they don't have access, they don't have the ownership to the land, right? And that's exactly why it's not final. We are working with the government of South Africa. We're trying to put together a solution exactly to share the risk to MSMEs financing, where we will deploy financing through the banks, but where there will be like a structure to share the risk with the banks on MSME lending. And we hope that going forward and that getting approved by the government of South Africa and by ourselves, we hope that will support scaling up our support to MSME financing. You are very right. It's not a matter of lack of capital. It's about risk and risk appetite.
And maybe just before we end off, looking regionally, perhaps Southern Africa, where are you seeing more appetite when it comes to funding these projects? We've been, talking about the agri sector. There's a lot of focus on tech as well as renewables.
Where I see the biggest appetite remains very much on infrastructure and on the extractives.
Okay.
Pretty much the traditional big investments, right? And where the big gap is exactly on financing the ecosystem. I'll give you a simple example. If you have a big mine, yes, there is a lot of investment going to the actual mining activity, right? And then to the, let's say, to the downstream of the mining. But then what about the ecosystem? The development of the SMEs that will be the supply chain to that mining, in the small suppliers to that mining. There is not much financing available from the financial system unless the mining company itself provides some sort of suretyship to it. And that's exactly what we are trying to break by every time there is a big investment, to have what it takes to also share the risk of independently of the big company with the financial institution to help boosting the SME activity.
That was Cláudia Conceição, Regional Director for Southern Africa at the International Finance Corporation.